one of the core mechanisms of any retirement plan is tax planning because it affects everyone. It's the governor of the thing that's probably your largest bill in retirement. Welcome to the How to Retire on Time podcast. I'm Michael Decker here with David Franson. This show is all about getting into the nitty gritty, not that oversimplified advice you've heard hundreds of times, and we're answering your questions. Text them to 913-363-1234, and we will feature them on the show. How about that? That's a good time. David,
Yeah.
what do we got today?
Yeah, featured on today's show. Hey, Mike, when does tax planning really make a noticeable difference in a retirement plan?
Tax planning affects everyone. And so I would say there's a significant difference that can be felt for all people in retirement.
All right.
But it's a different conversation for every person. Let me explain. If you have less money, let's say $500,000 or less,
All right.
or you want $80,000 to $90,000 or less of income, net income, right? So the money you're actually spending in retirement, versus you're in the, I want 120,000, 200,000, 500,000 of income in retirement, or so on, or you've got $3, $4, $5 million plus. Very different conversations, and here's why. Tax planning is a red light, green light situation. So, do you go fast and aggressive, or do you slow down? Okay, and what I mean by that is, if you want less income, if you saved less, you might not want to aggressively move your IRA assets to Roth because you could slowly do it in the 10 to 12% tax bracket with the standard deduction and pay very, very little. That also allows you to keep more money in your portfolio, which allows that compounding effect to benefit overall in your retirement. Because people forget, just because you're not taking a lot of income doesn't mean you're being depleted. So if you're doing aggressive conversions, money's going to the government in taxes, which is also depleting the amount of money in your portfolio. And that can have a lasting consequence. So if you've saved less, this goes against common wisdom, common consent, or whatever the zeitgeist, if you will.
Sure.
But I do a lot of plans with a lot of people where I say, don't do any IRA to Roth conversions. It doesn't make sense. And let me give you an example. If you've got $1 million and the government just comes out and says, hey, everyone, we have, for this year only, we've this new bill, you can convert as much money as you want from IRA to Roth, and you're going to pay a flat tax of 20%. That's it. Sky's the limit.
Yeah.
Okay. Or you can sign a little waiver and says, we're gonna govern you a little bit. You can only do so much, but you can pay 15% for life. Which would you do? So if you do the example of convert everything over, you're going to take your $1 million, pay $200,000 in taxes, 20%, and you've got $800,000, but you're tax free. Right?
That sounds
Your
good.
grows tax free, pays out tax free. Life is good. You are done.
Love that.
Okay.
Love being done.
In that situation, you paid $200,000 in taxes for life.
Mm-hmm.
Not a bad deal. If you compare the option to 15% for life, it's the same growth, same inflation, same net income. Okay. You'd pay around, in this example, I think we did it like 60 to 95 years old or something like that. You'd pay around $412,000 in taxes, roughly.
So on paper, it already sounds bad. Like I'm paying double in taxes. No one wants to do that.
Yep. So it sounds worse off, right?
Yeah.
Here's the catch.
All right.
The person who paid more in taxes throughout their life, because they spread it out and they never quickly depleted the balance in there, ends up with over $700,000 more in their portfolio. I think $690,000, $700,000, it's around there.
Yeah.
More money in their portfolio going to the kids, going to charities, going to wherever they want.
Yeah.
And the reason is 10% growth, let's say, of $1 million is a better deal than 10% of 800,000.
Yeah.
That difference adds up over your lifetime. So for people with less money that can navigate a lower tax bracket for life, your effective tax rate is much less, and it's more advantageous for you to slow down and keep the money in your portfolio so there's a compounding effect moving forward. Now, the opposite of it is someone who's saved more money or has too much in their IRA assets. You got to understand that your effective tax rate, that's the total amount you've paid in taxes, early in the 32% bracket today is still a better deal than the 25% bracket back in 2016.
Mm.
Even though you're in a higher bracket,
Yeah.
you've got to pay attention to the dollar thresholds and the lower bracket thresholds, because our lower bracket thresholds 10 and 12% when back then was 15%.
Okay.
So it's hard to do the apples to apples comparison unless you look at the effective tax rate. Total taxable amount, taxes paid, what was that percentage?
Right.
And so someone who has a lot more money, who is planning on more income, might want to get more aggressive going to the top of the 24 bracket or even a little bit into the 32nd% bracket, because if taxes change in the future, it could really hurt you.
Mm.
So this is why tax planning affects everyone, and it prevents you from making an emotional decision of doing too much too soon or too little too slow.
Oh,
It's a two-sided coin,
right.
double-edged sword.
Yeah.
What other axioms or sayings you can put in here? Insert them now.
Yeah. I don't know. I think those two did it.
But do you see how it's balance? And everyone's situation's different.
Mm-hmm.
And if you're, this is one of the keys that many people miss. If your required minimum distribution is less than the income you already want, why in the world would you be panicked about taxes?
Mm.
Because you can just take your RMD, call it good. You need more income anyway, and then pepper it in with maybe a little bit more from IRA assets, just because you want to deplete them, or maybe you take a little bit from your brokerage account at 0 to 15%, long-term capital gains rate, or maybe you buffer in a little bit of Roth because you have too much in Roth, or what? Hard to say too much in Roth,
Yeah.
but I mean, I guess in theory it could happen. But it's about balance and individual situations, as opposed to this blanket statement advice that costs people tens, if not hundreds of thousands of dollars throughout their retirement going the wrong direction.
Mm.
And this idea that you can predict the future, no, you can't. No, you can't.
No.
It is acceptable to say, I'm concerned that taxes might go up in the future. That's a reasonable expectation, and to then create your plan around such. It is unacceptable to say, I know taxes are going up in the future.
Oh, right.
I mean, that's like saying, I know Trump was going to get elected. At one point, he was like a 4% chance of getting elected.
Yeah.
Like, did you really know? Really?
Nope.
That's why prediction markets are so fun to watch.
Yeah.
Because, usually they're right, but sometimes they're not.
Yeah.
It's like what March Madness.
Yeah.
Every now and then there's that
Cinderella.
story.
Right.
You don't know,
No, you don't really know.
but you can make an argument saying the odds point in this direction, and I want to prepare for a probable outcome. Totally get that.
Yeah.
But you don't really know.
No one really knows, like, oh, that 10 or that 12 seed is going to make it to the Elite Eight or Final Four. You just don't know.
Yeah. It's so fun, though, when the 16 seed beats the 1 seed.
Oh, it doesn't happen very
and
often.
like 90% of brackets are gone.
Yeah.
So, but here's the point. And I'll be very blunt about this.
All right.
Investments in products and all of that, yeah, that's an important part. Yeah, the planning's an important part.
Mm-hmm.
But I think one of the core mechanisms of any retirement plan is tax planning, because it affects everyone. It's the governor of the thing that's probably your largest bill in retirement.
Mm.
And understanding when to turn it up and when to slow it down is a critical component of any retirement plan. And everyone's threshold should be different. And to try and do tax planning with someone that can't give tax advice, in my opinion, is kind of like trying to cook a steak without a grill or a stovetop or something.
Yeah.
I don't know. It's kind of a weird analogy. It's like trying to play baseball without a bat.
Yeah. Okay.
Like, I don't know. These are all terrible analogies, but I don't see how it could possibly work.
And how do we know who can give tax advice?
Simple. Are you allowed to give tax advice? If
Uh,
they say yes or no, that's your answer.
Okay. All right.
Because anyone can talk about taxes. You have to be a CPA or an enrolled agent to represent you in front of the IRS. So from legal advice, that's one thing. And a lot of compliance departments will say, well, we can't give legal advice. I get that. But to do tax planning and say, oh, well, I can't really do that side of it. I can't give tax advice. So we'll help with your investments. You got to talk to a CPA, though, about that stuff. I think many times it's been misunderstood of what people can and can't do.
Mm-hmm.
Most advisors will say, well, we can do IRA to Roth conversion advice. That's tax planning. That's a part
Yeah.
of it. But oh, well, we can't really go through your 1040 tax return, the summary of it, and work with you there. That. Why not?
Mm.
Why can't you look at that and say, hey, look at line 3A right here. You've got a lot of, 3B. You got a lot of ordinary dividends coming in. That's tax inefficient. Why don't we reposition the portfolio so that 50,000 stops getting taxed as ordinary income and we can move it over to 3A, which on your 1040 is qualified dividends. Those are taxed as long-term capital gains. That's a tax efficiency. Or we can rebalance the portfolio to have the dividends go in your qualified account so that, this
Yeah.
is what it should be like.
Right.
But if it's like, oh, I don't know how to read a 1040. Oh, that's what your CPA does. Like, I'm more on the investment side.
Yeah.
I don't see how you can do this job without being able to read and understand how taxes are filed, how to read a 1040, how to simulate a tax return in the future. I don't see how it can be done effectively.
Right.
So
I get that.
anyway, that's my opinion. Did we answer the question?
I think so. Let's just review it real quick. Yeah. When does tax planning really make a noticeable difference? So certainly in the higher income, like
Makes
way
a
up there,
huge difference.
maybe not as much in the lower if you only have.
Makes a huge difference. But it's the balance that you preserve. It's the slowing down of the tax minimization strategies that allow you to keep more of your assets and to help other parts of your plan.
Mm.
Your income planning affects your tax planning. Your tax planning affects your income abilities. Your tax and your income planning will dictate then when you should file for Social Security.
Yeah.
But when you file for Social Security, it's going to affect your tax planning and your Social Security. And healthcare, by the way, is really a tax planning issue and an income planning conversation.
Uh-huh.
So it all works together.
Then you've got IRMA in the mix as well, right? You
Yeah.
gotta be mindful of that.
Yeah, not your crazy aunt. IRMA is Medicare surcharges. If you go over a certain threshold, $1 over,
Yeah.
you're paying more for your healthcare expenses, your senior healthcare.
What if you converted too much from IRA to Roth and then suddenly IRMA you're paying more for Medicare?
Yeah, yeah,
You got to be aware of that.
crappy situation. I mean,
Right.
you could look up Form SSA-44 and try and get out of it,
Mm,
but still.
right.
So it affects everyone, but they're different conversations for different people. And I think that's often misunderstood. Tax planning is for the rich. No, it's not. It is almost just as important, if not more important, for the efficiencies of someone that has less than $1 million on how are they going to gracefully take money out while preserving their portfolio and maximizing the efficiencies of the current tax situation.
Got it.
That's all the time we've got for this question. If you enjoyed it, make sure to subscribe, tell a friend, all of that. Go to retireontime.com, by the way, as well, to grab the book, the workbook, all these materials to help you prepare for your retirement. We'll see you in the next show.